Assalamualaikum.wr.wb. Let me introduce myself. My name is Vena Ameliya, NPM 234120039, Accounting Class 23A, Advanced Financial Accounting Course. Okay, here I will explain about intercompany ownership. Let's discuss it directly. Intercompany ownership reflects the relationship of share ownership between one company and another. Common practice in the business world, especially in corporate groups that have several subsidiaries. This relationship creates complex reporting needs so as not to mislead users of financial statements. Types of intercompany ownership. Minority ownership, less than 20% does not have significant influence. Significant ownership, 20 to 50% uses the equity method. Controlling ownership, greater than 50% requires consolidation of financial statements. Form, parent and subsidiary, joint venture, association. Objectives of consolidated reporting, to provide relevant and reliable information to users of financial statements about the financial position, performance and cash flows of the group. Prevent distortion of information due to double recognition of transactions between companies within the group. Present financial statements, as if all entities within the group were a single economic entity, provide a basis for economic decision-making for investors, creditors and other interested parties. Simplify the understanding of complex corporate structures for external users. Financial statement consolidation process 1. Identification of subsidiaries controlled by the parent entity, directly or indirectly. Point 2. Alignment of accounting policies between entities in the group to be uniform. Point 3. Adjustment of reporting periods if there are differences. Point 4. Elimination of all intercompany balances and transactions, including sales, accounts receivable, dividends, and unrealized profits. 5. Recognition of goodwill or gains from bargain purchases at the time of acquisition. Point 6. Disclosure of non-controlling interests, NCI, in the financial statements. Point 7. Presentation of consolidated statements, balance sheet, income statement, changes in equity, cash flows, and notes to the financial statements. Elimination of intragroup transaction sales/purchases between entities. Sales and purchase values must be eliminated to avoid duplication of income. Intercompany receivables/payables. Balances must be eliminated to avoid depiction of assets or liabilities that do not reflect the financial position of the group. Intercompany dividends. Dividends received by the parent from the subsidiary need to be eliminated because they do not generate cash externally. Unrealized profits. Profits on sales of goods between entities that have not been sold to external parties must be eliminated from consolidated profits. That's all for me to end. Walaikum salam.